Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Lots of people ask us questions. Some even go to the trouble to send in an Ask the Guys question. And for those people, many of them will get answers today as we take your questions on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, it's our financial strategist and co-host, Russell Gray.
Hey, Robert.
You know, we have the best listeners in the world.
We do.
And today, we're going to hear from some of them. We do this about every couple of months, and we actually could do it more often. We get tons of cards and letters in the form of emails called Ask the Guys. So today, we're going to answer a bunch of questions from listeners. They kind of have a big range of things that they're interested in. What we do is try to pick the ones we think are universally appealing. So lots of specific questions we really can't get into, and unfortunately we no longer have time to answer them all personally, but we got a bunch of great ones today. So before we get to question one, just a couple of caveats. First of all, the Real Estate Guys are not tax or legal professionals, and secondly, we don't give advice. Instead, what we give you is ideas and information so that you can go seek the actual advice you need. With that out of the way, here's question number one. This comes from Lloyd in Canton, Georgia. He says, "Hey guys, my dream is to own 2 to 3 homes that I can rent out. Where do I begin, and what do I need to watch out for?" Well, Lloyd, I started with that one because it is a great basic real estate question, but we probably could do a whole show on it. Let's just start with some of the basics. The whole idea of having rental homes is so you can get your money to work instead of you. Now, some people who buy single-family homes like to do the work to fix them up, make them nicer, improve them. They'll rent for more, sometimes to sell, sometimes to hang on to. But for most folks, it's like my mentor Jim Rohn used to say, kids should have 2 bikes, one to ride and one to rent. And why not the same with houses? So having a goal to have some houses to rent out makes a ton of sense. And where you have to start is with what we call personal investment philosophy. This is who you are as an investor, what you want real estate to do for you, how involved you want to get versus hiring people to do the work, and what your resources are.
Yeah, when we talk about investor resources, we categorize them into the 7 essential investor resources: cash, cash flow, equity, credit, and time, talent, and relationships. And so when you ask the question, what do I need to do to get started? The first thing is you start your education, which you're already doing. You're listening to shows like ours. You're asking people who are qualified to have an opinion good questions. Put yourself in an environment as much as you can where you can be around more experienced real estate investors and ask questions. And when you ask them questions about their personal investment philosophy, how they've chosen to invest in whatever they've invested in and how it's going, you're going to learn from their experiences things that will help you make better decisions in your experiences. One of the things that I find, of course, coming out of the mortgage business, is that a lot of young people who are just starting out and don't have a lot of money, don't realize how valuable their credit score and documentable income are. One of the very first things you want to do is go meet with a mortgage professional as quickly as you can. Don't wait till you think you're ready to be an investor, because it can take up to 2 years to really prepare your financials so that you can borrow effectively. And borrowing is one of the most important aspects or strategies for investing in real estate. So, to me, you say, where do I get started? Put yourself in the right environment to ask people great questions, work on your education, work on your personal investment philosophy, and then get with a mortgage pro and figure out how to manage your credit score and your documentable income so that you can borrow effectively. And while you're doing the work that you need to do to prepare yourself to be an effective borrower, you can be working on aggregating a down payment, looking for down payment partners, shopping for markets, building a team in the markets that you're interested in. So there's a lot of work to do before you pull the trigger. But that's where I would start.
Yeah, and I think Russ hit on a couple things that I'll just amplify a little bit. Markets is a huge one. Where do you want to invest? I say live where you want to live and invest where the numbers make sense. You might live in a market where there's good rental property, but maybe not, which means you have to start thinking about market analysis. Which markets make sense? Which are more tenant-friendly versus landlord-friendly? And what about that help, that team you need to put together? Real estate agents and lenders and property managers and legal professionals. So that's where you begin. We could go on, but that gives you at least a nutshell of an idea. What do you need to watch out for? Well, I think one of the primary things, and there's all the usual stuff that everybody talks about, but something that we tend to talk about is making sure you don't mismatch your strategy with the market. Let me give you an example. We had a guy many years ago came to one of our events and he goes, I have a problem. I bought 3 houses in this particular market and I want to get rid of them, but they haven't gone up in value. They provide decent cash flow, but they're essentially worth the same amount that I paid for them 3 years ago. And of course, when you go to sell real estate, you're going to incur 8 to 10% in transfer costs, commissions, and so forth. So what he had done is he picked a cash flow market, but his strategy was for them to go up in value over time, and he didn't pick the right market. So his strategy didn't match the market. You can find markets that don't appreciate very well, but spit off a ton of great cash flow if you're minded that way. On the converse of that, you can find markets where the properties tend to go up pretty consistently, but it's hard to make them cash flow. So you really have to spend time thinking through all this stuff, and I am agreeing 100% with Russ. Education is the first step, so keep that up. Don't feel like, oh my gosh, I'm going to miss out if I don't buy a property this month. That's just not true. Real estate markets move slowly, and real estate investors take time to get educated.
Yep.
So great question, Lloyd. Our next question also comes from somebody starting out, Blake in Gretna, Louisiana. Hey guys, I'm 20 years old and I want to get into real estate. I want to grow my capital and invest until that can become my full-time job. Right now I have a trade job where I'll currently be making about $80,000 a year. I always wanted to work for myself, so how can I invest this money properly in real estate so I can do that as my full-time job? Thanks, guys. Well, Blake, absolutely the time to think about it is now. When folks start out, they usually don't have a big pile of money, so you have to do something to put money away. So rule number 1 is to live below your means. $80,000 is a great salary, and I'm guessing in Louisiana you can live on a lot less than that. So that's your mission. Live as frugally as possible until you get a stake in the game. You don't need a ton of money, as we just talked about. If you're going to leverage it, 20% down and 80% loan to value, a lot of places, great rental properties sell for $60,000 to $80,000 to $100,000. So you need a ton of money, but you have a unique advantage, and that is you're in the trades, which means you know a lot about the construction side already. That's one of the doors into real estate, is people that already work with their hands, understand construction, know how to add value. That wasn't my door. My door was through sales and investment. Kenny McElroy's door was through property management. So one of the basic rules in investing is to start where you are with what you have. And in this case, you've got something more than just the money you'll be saving to work with.
Yeah, I'm going to go back to what I said earlier, which is get yourself to a mortgage professional at 20 years old and pay some attention to your credit score and do the things you need to do to begin to ratchet that up. Understand what debt to income ratios are. And to Robert's point, when you say live below your means, it's more than just saving money. It's about saving ratio and having the ability to take on house payments or property payments against your documentable income, which sounds like relative to what your cost of living is going to be, could end up being real good. But if you go buy yourself the big fancy car, you get yourself the big fancy apartment, you maybe buy yourself a toy of some type, and you finance all that stuff, you're going to use up a lot of that valuable cash flow that you could use to leverage into real estate, making payments on things that aren't going to make you wealthy. Robert Kiyosaki calls those things doodads, and you don't need them in your life, at least not early. If you do it right, you pay for your doodads with the income from the properties that you purchase instead of the payments for your fun things coming off the sweat of your back. They come from your properties.
In the 7 Habits of Highly Effective People, one of the things Stephen Covey says is to begin with the end in mind. And so I think if your mission and your goal is to be a full-time real estate professional, investor, whatever that looks like for you, then that's a big part of it. Knowing that your job now is a means to an end, great. Just so you're aware of that and you can be working towards that. And then I would also say, kind of echoing from the previous answer, start getting around folks who are into this stuff. There's local meetup groups, come to seminars, start to meet people that are doing what you want to be doing. That gives you insight into what that life is like and also can give you kind of a leg up.
So I have a quick add-on there real quick for both these guys and anybody listening. Don't discount, in fact, highly esteem the value of putting together a team. Don't just work on your financials. Don't work on your down payment or just on your down payment and just on your credit score and your borrowing ability and even your education. Put a lot of emphasis on getting the right team together, because when you need to make decisions, you want to move quickly. If you're going to be doing rehabs, you got to have people who know how to do that. If you're going to be doing property management, then you're going to want to make sure you have a great property management in place to manage those rental properties. So if you're going to be purchasing existing inventory, whatever it is you're going to be doing, you're going to need people to help you. And so remember, the most important thing you build in this business is relationships. Because if you have great relationships and a great reputation, everything else you need, you can get. With that said, if you have bad relationships and a bad reputation, even if you have a lot of things going for you, it's an uphill climb.
It's Ask the Guys. Your questions are answers. If you have a question for the Real Estate Guys, go to the website at realestateguysradio.com and click Ask the Guys. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Jerry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
If you want to learn how you could potentially increase your net worth by over $1 million and quit your job in just a few short years, listen closely for the next 60 seconds. This is Brad Sumrock, and over the past 16 years, I've helped thousands of people invest profitably in real estate, but not just any type of real estate. I specialize in helping people syndicate large apartment buildings so that they can be business owners and investors. In today's competitive environment, it's even more important than ever to leverage an experienced mentor, invest in your education, and have a team of advisors that has established relationships nationwide. And so many people right now seem to be struggling to find deals and then get them funded, but yet Sumrock students are thriving in today's marketplace. We've purchased nearly 7,000 units and nearly $1.5 billion in purchase volume over the past 12 months. And with the new Trump tax laws, apartment investors are positioned now better than ever before to pay even less in taxes. To find out more, send an email to apartmentsnow@realestateguysradio.com and you'll get my recent presentation called Why Apartments Now. That's apartmentsnow@realestateguysradio.com.
Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, and you're listening to Real Estate Guys Radio.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com and your favorite podcast outlets. If you've ever wanted to do bigger deals using other people's money, well, then it's time for you to head on out to the Secrets of Successful Syndication. We do this 2-day event twice a year, and the next one is coming right up. Get all the details at realestateguysradio.com under events. Whether you want to syndicate deals or passively invest in bigger deals, come on out and learn what it's all about. Today it's Ask the Guys. Your questions are answers. A lot of great questions today. More than we're going to have time for, but that's okay. We're going to do another Ask the Guys show before you know it. This one comes from Jacqueline in Punta Gorda, Florida. She says, "Hey guys, I read with interest your email regarding equity sharing by helping a young person with a down payment on a house. In such a situation, would the investor appear on the title, or would the entire transaction be behind the scene with no official recorded interest in the property?" Well, Jacqueline, that's a great question. And I will say, to start with, there's a bunch of ways it can be done. But the premise of equity sharing is when you have two parties who are both involved in the transaction but want different things out of the transaction. The classic equity share, and Gosh, my dad and I helped folks do this for many, many years when I was starting out my real estate investing career. It was a different lending landscape back then, but the idea was you've got, say, a young couple, they're making good money, they could afford to make a house payment, but they haven't saved up the 20% necessary. So they go to somebody. Could be a non-related person, or it could be friends, family, parents, and that co-investor brings in part or even all of the down payment. That's the idea of equity sharing, is one person puts up the money, the other person qualifies, makes the payments, and then you split the equity in the future on some basis. Now, today, you'd have to work with your loan professional, and they'd have to understand all of the relationships. If it's mom and dad and a kid, that looks different than if it's what they call a non-related co-borrower. It's still possible, however, but what changes all the time is lenders' guidelines and what that has to look like. Typically, you would want both those parties to be on the title, and you'd work with your lending professional. You're never going to hear the real estate guys talk about anything that's, behind the scenes. Don't tell anybody, it's a secret over. No, we're very much about being transparent, being legal, and doing the right thing.
Yeah, I think that it really comes down to getting good advice. So the lender is going to make you a loan based on representations that you make, and they're going to have criteria by which they will make the loan. So if you're going to omit or misrepresent a material fact, something they're relying upon to make that loan, you're going to find yourself in trouble. So before you have a deal in place, I think you just want to go see both a real estate mortgage professional for the particular type of product that you're thinking about. I think most of us think about these things as just single family homes, but real estate is a lot bigger than that, and you can equity share anything you want. So you want to talk with a mortgage professional that is going to make the kind of loan that you're going to be looking for the kind of property you think you're going to do this with. Second thing is you want to get a real estate attorney in the specific jurisdiction that you're going to be doing the transaction in and talk about the options there. You may also want to even consult with an asset protection or an estate planning attorney, because there's going to potentially be some contractual, maybe even an entity involved that is going to designate rights and responsibilities of the parties that are in the transaction. But the principle can be done either way. If it's the right property and the right lending criteria, then you could be on the title if you felt like you wanted to be, or you could be behind the scenes controlling the property through an option or through an entity that obscures the direct ownership from anybody that doesn't have a right. In other words, you don't have to be on the publicly recorded deed. There's all kinds of properties out there that are under the title ownership of an entity or a trust, and many people do that for privacy reasons. If you're going to be investing for tax benefits, and you're going to want to have a tax advisor involved as well, and that may affect how you choose to take title. So, the concept is great. To answer your question, whether it's going to be recorded or not, or whether it's behind the scenes, it depends. It depends on what you want. It depends on what the lender will accept. It depends on what the local law will accept. It depends on what your partner will accept. Can it be done? Yes. Does it need to be done that way? No. It's the thing that's great about real estate is there is no one-size-fits-all answer. You can custom create an arrangement that meets the needs of all the parties. And that's kind of the fun. That's the art form of doing real estate.
And here's one of the things about equity sharing. In addition to purchase contract, lender documents, disclosures, you also need an equity sharing agreement. This is where the two parties decide, hey, how does this work? Who's responsible for what? How are we sharing the tax benefits, the benefit of sale, and then things like first right of refusal to purchase. Typically, the occupant of the property is given the first right to purchase out the interest of the other person because they're living in the house. It makes sense, but it doesn't have to be like that. And if your contract is silent to that, then it's a whole can of worms. So you do definitely want to work with an attorney. Before you sit down with an attorney at hundreds of dollars an hour, make sure you talk through with the partners exactly what you want it to look like. One other thing just to be aware of, and the reason that you don't want to hide anything from the lender, first of all, that's fraud. But secondly, keep in mind, a lender is concerned with two things: how are you going to pay him back, and what happens if you don't. And the reason lenders want 20% down typically is because they want skin in the game. So if one party has skin in the game and the other party's only qualifying for the monthly payments, the logic the lender looks at is, will that party, the one that doesn't have any real money in the deal, will they walk away after 2 or 3 months? So you've just got to address all that, and you can do that with a great mortgage professional. So great question, and a lot of great questions today. This next question, there's actually 3 questions in a row that I've kind of lumped together for, I think, a strategic reason. So I think, Russ, what I'll do, we'll go through the questions, and then we'll kind of answer the big picture. So the first is from Alvina in Falls Church, Virginia. She says, hey guys, I'm interested in purchasing turnkey property for cash flow income. Would you recommend Terry Kerr and his team at Mid-South Home Buyers to buy properties from? How long have you known them? And do you take any responsibility if I have a bad experience with them? Okay, awesome. Hold that thought. Question number 2 comes from Jeffrey in Aubrey, Texas. Hey guys, I'm a big fan of your podcast, and I recently listened to one you did a couple of months ago with Gene Garino that has me scratching my head. After hearing the podcast, I did some research, and there are several red flags about his model, which seems geared toward getting folks to invest in his high-dollar classes, which seem to provide marginal utility. Both of you spoke glowingly of Gene and his academy, which is why I'm conflicted. Do you implicitly or explicitly endorse folks when they come on your podcast? I value your opinions as to what's legit and what's not, and the situation has me wondering if that's a fair burden to put on your lap. Of course, I would perform any due diligence in any case, but I'd like to know what your position is when you have folks like this on your show. It's not a criticism, as I appreciate what you both bring to the investor world, but I might have to recalibrate how much weight to assign to your apparent endorsements. Thanks for any clarification. That's an awesome question. Hold that thought. And the last one comes from John in San Diego. Hello, guys. Really appreciate all your information, and I've been following you for a while. How do you receive your compensation? Does any of it come from the companies you promote? Thanks for the great info, John. All right, well, the first reason I wanted to lump these all together is they all have to do with what the real estate guys call providers. And in our world, as a provider is someone that can help you live out our motto, which is education for effective action. In the old days, we used to just lather people up and get them excited, and then they'd say, well, who can help me? And we'd say, well, figure that out on your own. Over the years, we developed great relationships with folks that can actually help. And so I think we'll start at the bottom, which is our compensation. So it's pretty traditional in radio, and we're a radio show first, still on terrestrial radio, have been for 23 years. The fact that we take our show and then podcast it is awesome because we reach people in more than 190 countries that way and millions of downloads, so we love that. But we're a radio program, and so radio programs have advertisers that say, hey, that audience might be interested in what I'm doing. Can I sponsor your show? Now, we don't just take anybody as a sponsor on our show. In fact, there's a vetting process.
So I can talk to that because I've personally done this for many years, and then eventually we built a team that does it. But the process basically works like this. When someone contacts us, and we get contacted all the time by people who want to do that, we have a call to action for people who want to do that. We solicit people to do that. We're always looking for good sponsors for the show. The reason we're looking for good sponsors is to Robert's point that we found out that our motto, education for effective action, works better when there's a shorter gap between education and action. When the boat is too far away from the dock, people can't make the leap and they just fall in the water and never own anything, and you can't make any money on real estate that you don't own. So it's very important for you to be able to get connected to people who can help you. So that's what our resource center, that's what our resource network, our provider network is all about. When people contact us or we see somebody that we think is interesting, the first question we ask ourselves is, do we think they have a product or service that would help our audience? Is it a fit? Do they line up with our philosophy? Do they offer things that we believe in? Are they in markets that we think make sense? If the answer to all those questions are yes, then we have a team that does a reputation search on them, and they look them up online, and there's a whole checklist of things that they look for just to make sure that they're not glaringly bad people. Now, everybody steps in it from time to time. There are no perfect people or no perfect companies. So if there's something, we may decide to continue the conversation and actually do a one-on-one interview. Then what happens is our gal who runs this department gets these people on the phone. She explains to them our mission, our vision, our values. She explains to them their responsibilities and what we can help them do to promote their business and what they are expected of them in terms of the way they interact with our audience. And if they buy off on that and like that, and she's approved of them, she works out whatever the deal is, the business side of the transaction, and then they get on the phone with me. And then I do a conversation with them to reiterate what the mission, vision, values is and just back up to make sure. So that's been the process for many, many years, and that's how people become part of our provider network. Once they're in the network and we start promoting them, we have a mechanism to follow up with people that have engaged with them in some way, because in some cases, if they've requested something on the website or a free report or something, we know that there's been an engagement. We follow up, and maybe some of you listening have had that, and you get an email saying, hey, we're just checking to see how's it going. If we get something good, we use it as a testimonial, and we are encouraged to promote that person even more. If we get something that's bad, we take a look at it and try to find out, hey, is this just somebody who's upset? Because there's always two sides to every story. Is this a pattern of behavior? Is this just one of those things where something went sideways and it was, nobody's fault, but it was just one of those things? And there are a few people over the years where we've parted company. We found out that they were bad actors. They vetted well. They looked good. They talked a good game. But when we put them on the field and asked them to play, they didn't treat people right, and they're out and they're gone. So all that to say that our endorsements are not for sale. We don't just endorse anybody that'll write us a check. When we decide to put somebody into the provider network, we have this process that we go through, and we have a checking process that we do. We have an accountability system that we go through. With that said, we don't warranty anything with anybody. We're a radio show. So if you were to listen to a radio show and call up a flower shop and order flowers and they send the wrong flowers, you don't blame the radio show. You take that up with the vendor who sold you the flowers. And it's the same here with us. So we take pride in who we put out there because it's our brand. It's our responsibility. We've been at this for 2 decades. Our brand is important to us. But obviously, we can't take personal responsibility for the business transaction 2 people get involved in. So always do your own homework. With that said, we always want to hear from you. If you have an experience, good or bad, that you think we need to know about, we read everything you send us. And so we're very much interested in hearing about your experiences so that we know what's going on out there, because, otherwise we're just 2 guys with a microphone talking in a studio somewhere. We really don't know what's going on in the real world. We really appreciate those of you that take the time to come to a live event where we can have an eyeball to eyeball conversation. And we love those too. So in terms of our compensation model, we make money, yes, from our advertisers. We also make money on our events. That's a business. Our annual Summit at Sea is something, and our seminars and things that we do. We have our syndication mentoring club. We do some training for people that are interested in raising money. So that's a part of our business model. We try to have diverse streams of income in our business. And so we make money in a lot of different ways. And we have our development company that is something that's completely outside the Real Estate Guys radio show and the things that we do that aren't part of the show. So I would say we're a couple of busy guys and have a lot going on, and we manage to pay the bills somehow, some way. But we feel good about the people we promote, and we have a process to make sure that you have a good chance of having a good experience. We do our part. Your job is to do your part, and then talk to us and let us know how it's going so that we can make sure that we protect everybody by getting real world feedback.
If you've listened to our show for a while, then you probably are tired of hearing the same providers, and that's because these folks stay with us a long time and vice versa. Now, if you heard somebody and they're no longer here, well, that's a clue. We don't come on the air and say, hey, we found out this was a bad actor. We just, it's just kind of, if they're no longer involved, that should tell you what you need to know. Specifically, Alvina asked about Terry Kerr and his team at Mid-South Homebuyers. I don't know that we have a single better provider than Terry in terms of feedback from listeners in all these years. And we've been involved with Terry Kerr for nearly a decade. In all these years, hundreds and hundreds of Real Estate Guys listeners have purchased houses from Terry and his team, and I don't think we've ever had a negative comment.
Never. Lots of positive ones.
Lots of positive ones. So I will tell you this. He's in demand, so there is often a waiting list to get a property. Terry will not compromise what he buys, how he fixes it, how he manages it, so it means sometimes there's a big old line. When we first met Terry, he had a dozen properties on his website at any time that were available. Today, it's a 9 to 12 month waiting period. They are working on it, but don't expect you're going to jump in there and get to the front of the line. It does take some time, so I love those guys. Let's talk about Gene Garino. Jeffrey asked specifically about that. Gene is absolutely an educator, not a guy that sells properties. So his education is first class. It involves 3 days, so it's expensive, and an actual bus tour to some of Gene's own residential assisted living homes. So it's very tangible. He's a guy we've also known many years. He walks his talk. He does the thing he teaches about, which we love, and you get to see that when you take part in this training?
Yeah, so I've personally been to Gene's training twice, fully, been inside of his homes and seen the operations myself. Robert, you and I have been in one or two of the students' homes and interviewed the students in their homes. If you go back in the archives, you can hear those interviews. We've had many of our listeners come and tell us they've had great experience, real world success. Not that, oh, the training was great and I have so much hope, but no, I took the training and actually went out and did the thing, and I own 1, 2, 3, 4, 5 different properties, and they're all doing great. Gene's very supportive of his students. He cares genuinely about their success. He's become a good personal friend, to be candid about it, but that's, he'd still have to do a good job. The fact that he's my friend wouldn't mean that we'd endorse him if he wasn't doing a great job. You can't please everybody all the time, and usually that's the shortest path to failure. But Gene is very good at what he does. To Robert's point earlier, he's not here to sell you an assisted living facility. He's here to show you how to build one, and he's very good at it. He's got a whole team of people that do it, and we've seen lots and lots of success. So we don't hesitate to point at Gene. Again, if somebody out there's listening has a different experience, we'd love to hear about it. But, other than, a few bits of chatter here and there about people maybe that had a personality conflict or, took exception to the fact that he actually tries to make money in selling his education, which I think is worth it. I mean, it's not how much it costs, it's how much does it make you. People say, well, how much does it cost? Well, if you take it or if you don't take it.
Right.
Or if you use it or don't use it. I mean, if you pay for training and don't do anything, that's not Gene's fault, because many people have taken that training and gone on to great success.
Well, in fact, Russ, you and I personally know not a few, but dozens of people that have taken Gene's training and gone on to invest in residential assisted living. Several of them have multiple properties, so it works if you do. Now, I will say candidly, I had lunch with Gene just a couple of weeks ago, and I asked him a very pointed question. And I don't think it's out of school to share, because I think he would be happy to answer this question if he was sitting here. My question was this: hey, Gene, of all the people that take your classes, how many actually do something with the education? And his answer was less than 15%. He goes, I think it's right around 14, 15%. And I said, you know what? That's awesome.
It's really good.
Because most people who go to an education course or training are not going to do it, whatever it is. If you get a hit rate of 2 or 3 or 4% in any kind of marketing, they say that's great. So the fact that 15%, even 10% actually do something is great. Now, just because the majority don't doesn't mean the training's bad. It means they decide after taking 3 days of training, either it's not for me, or it's more work than I thought, or wow, I'd rather spend my time doing something else, or hey, I'm just going to passively invest with one of the folks that's actually going to go do it, which is another outcome. So I think that's pretty awesome. But I wouldn't go expecting that just because you go to a training, you're going to be successful at doing whatever it is you've been trained for.
I think it's worth camping out on this for just a moment, Robert, because it's really a bigger question. If you go out, there's people that go to college and they go out and they build great careers and build companies and become multimillionaires. There's people who go to college and live in a mobile home, not disparaging anybody in a mobile home. But I'm just saying that they just never quite make the level of prosperity, and there's just a big disparity. And so it isn't the education. The education will work if you do, to your point. So when you're looking at making an investment of time and effort to go out there and build a future for yourself, you have to ask yourself, who am I? Am I willing to do the work? Am I a top 10%er? If 10% of the people can make it, can I? If you don't have enough faith in yourself to do it, then don't do it. Because ultimately, you're going to have to go out there and you're going to have to put your neck on the line. There's a lot of people that want the magic formula. They want the secret sauce. They think that it's about knowledge. We teach something. We say when you have a vision, a dream, something you want to achieve or accomplish. I want to be wealthy. I want to give to charity. I want to provide for my family in a certain way. I want to do whatever it is I want to do. That's your vision. And then you go out and you take training and you acquire the knowledge, the how-to. I know how to do what I need to do to go get what I want. But the problem is if you don't have the third component, which is discipline, where you actually do the thing that you know you have to do, then you don't get the result, which is effective action. So vision plus knowledge plus discipline equals effective action. Most people I've met aren't in the body they want to be in. They're too fat, they're too skinny, they're not in shape, whatever it is. Most people I've met just don't feel good about that. But you know what? Most people I know exactly what to do. The problem isn't knowledge, It's discipline. And the same is true in business. The education that these guys put out there, the education that we put out in the secrets of successful syndication work. We have people come in. We got one guy came in 5-6 years ago, raised $150 million. Another guy's raising $10 million a quarter. We have many people that are raising millions of dollars a year. But the vast majority of people don't do anything. We can't help that. They're all started in the same place, in the same environment. Some people chose to take what they learned and do it. Other people chose not to. Give yourself a chance by showing up. And then discipline yourself to do the things that you're supposed to do to be successful. Knowledge won't change you. Action will.
You're tuned to the Real Estate Guys radio program. It's Ask the Guys. More great questions when we come back. Plus, we're going to ask you a question for real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide. You're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Do you have a self-directed IRA invested in a syndication? Guess what? It's a ticking time bomb. Why? Because IRAs get hit with UBIT taxes, even Roth IRAs. Hi, I'm Damian Lupo, and we fix this problem for you forever. It gets even better because using the EQRP, you can literally get rid of taxes from all of your gains forever and protect your nest egg. The EQRP is the best vehicle to get it done. IRAs can't do it, not even Roth IRAs. You see, UBIT happens whenever any type of IRA invests in anything with debt. Don't worry, even if your IRA is already invested in a deal, we can kill that tax. Our team at Total Control Financial is here to give you control of your retirement money and free you from that deadly IRA tax forever. Want to learn more about the EQRP? Send an email to eqrp@realestateguysradio.com. I'll email you my special report and send you a copy of the QRP book. Paying a 37% UBIT tax is stupid. First step to getting rid of that tax is to send an email to eqrp@realestateguysradio.com today.
Hi, this is Anthony Melchiori from Hotel Impossible, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. It's Ask the Guys this week, and if you have a question for the Real Estate Guys, just go to the website at realestateguysradio.com. Click the button that says Ask the Guys. We try to do a show like this every 8 to 10 weeks. And we've got more questions today, but first, it's a question for you as we play real estate trivia, your chance to win a prize by knowing today's real estate trivia question. Of course, it has something to do with real estate, and as soon as you hear the question and think you know the answer, just send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll want to include your name, the answer to the question, and your mailing address, because if you're the winner, we're going to send you an awesome book called Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That could be yours if you know today's real estate trivia question. Last week on the show, we had Brad Summerrock talking about the apartment forecast for 2020. You can still get access to that webinar by sending an email to forecast@realestateguysradio.com. Here's what we asked. Name the official state bug of Delaware. Yeah, Delaware, like most states, has its own official state bug, which in this case is the ladybug. Yeah, the ladybug is the official state bug of Delaware. Here's our real estate trivia question for this week. What city is home to the oldest family-run restaurant in the United States? Obviously, it's been around a long time, and here's a hint. Not sure how much it'll help. The real estate guys have actually eaten at this restaurant. Do you know where it is? Send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, your guess, and your mailing address. And the first one that gets it right wins Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That's today's real estate trivia question. Most of the questions today are coming from you. It's Ask the Guys. If you have a question for the real estate guys, go to the website at realestateguysradio.com and click Ask the Guys. This one comes from Carolina in San Dimas, California. Hello, we want to open a self-directed IRA, my husband and I don't even know where to start. I contacted a company and they said that all the IRAs they sell are self-directed, which confused me because listening to your podcast, I found out that not all IRAs are good to invest in real estate. Please help me. I need more info to make the right decision. We want to roll over our IRA and 401k accounts to a self-directed IRA that we can invest in real estate. Thank you. Well, Carolina, don't worry about confusion. This is a confusing topic. When we started to research this many, many years ago, Russ went on a quest to find out the answer to this question because back then, Everybody in traditional financial planning, even in real estate, said, no, you can't buy real estate with a self-directed IRA. And as two guys that have done that, we will tell you, you absolutely can. However, it takes a little while to get your brain around it.
Yeah, there's a couple of different ways to do it, and I don't want to get too far into the weeds, but IRAs are a tax status. And so in the tax code, there are provisions to allow you to accumulate wealth for the long term, and you get tax benefits either when you put it in or as you're building it along the way and when you pull it out. Now, if you're self-employed, you have different options than someone who's working for an employer. Then if you work for an employer and they create your IRA, you're going to have very limited options. When you leave an employer, you can roll that over to a self-directed IRA, and depending on if you're self-employed at the time, you may have some options. Here's the thing. When people say all IRAs they have are self-directed, all self-directed means is that you can invest in anything you want to invest in that isn't specifically prohibited by the IRS. And the number of things that are specifically prohibited by the IRS is less than 10. It's really a small list. So really the world is wide open to you and all kinds of real estate is available to you. The thing that most people get hung up on and they're not aware of is that when you use leverage, one of the beautiful things about real estate is that you can use leverage. One of the challenging things with IRAs is that when you use leverage, you gain a benefit inside your IRA from something outside your IRA, which is the debt. And that creates a tax issue if you're not aware of it. And this is where the warnings come from. So you want to make sure you understand that UBIT, unearned business income tax. And so when you're talking to your IRA provider, make sure you understand that. The other thing that's great about real estate is depreciation. And the challenge is you really don't need it when you're inside the IRA, so you give up this huge tax benefit. So make sure that you pay attention to the tax aspects of whatever it is you're doing as far as real estate goes in your IRA, and take those things into account when you're doing it. Because IRAs can be great if you're going to own shares in a private placement and have that invested in real estate. There's no debt. You don't have to worry about depreciation. It's a very simple way to do it. It's a very popular way to do it. If you decide that you want to invest in real estate and you don't want to use any debt, then maybe you want to go ahead and put it in the real estate. I think Tom Wheelwright would argue maybe even then you don't. But since most people want to use debt when they use real estate, that's really what you want to focus your learning on. Damian Lupo, who you can find in our resource center, and if you go to realestateguysradio.com and look under resources in our provider network, you will see Damian Lupo's company, Total Control Financial. And he really has his mind around this because he actually was a big-time real estate investor and made a big mistake and learned, and then he decided to set up a company to help people avoid the mistake that he ran into. So rather than try to give that content here in an Ask the Guys episode, I just encourage you to go check that out, engage with Damian, and he can explain it to you.
Good stuff. Our next question comes from Asher in Charlotte, North Carolina. Hi, my name's Asher. I'm 32 years old. My wife and I are very interested in going on a Belize field trip, but we weren't able to make the one you just went on. Will there be another one later in 2020? Thanks. I've been listening to you guys for years, and you're a huge reason I own 15 rentals now.
That's awesome.
That's the main reason we wanted to answer your question. Good job, Asher. The Belize field trip we do 2 to 3 times a year, and typically once we do one, we put the new date out. So we had another question from a listener that wanted to have the next 3 or 4 dates. We don't do them that far in advance. It's all based on demand, and it's a market we love, and only small groups can be shepherded through that market. So the typical Belize field trip is 8 to 12 people. I just did one that was 9 people. The one prior to that, 17, which is a little too big. Anyway, here's what you do. Go to the website at realestateguysradio.com. Click on events. When you see the Belize Discovery trip, you'll see the next date, and we'd love to have you there. It's Ask the Guys. Your questions, our answers. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
All aboard! Registration is now open for the Real Estate Guys 18th Annual Investors Summit at Sea. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, authors of Prosper, Chris Martinson, and Adam Taggart, and the author of The Creature from Jekyll Island, G. Edward Griffin. Also back is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, CPA Tom Wheelwright, and Jim Rohn's 18-year business partner, Kyle Wilson. And joining us live and in person for his 8th Investors Summit, Peter Schiff. Plus, returning for a 7th time, the best-selling personal finance author in history, Robert Kiyosaki. It all begins June 11th in Fort Lauderdale, Florida. Visit realestateguysradio.com and click the tab that says Summit to book your cabin now. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit at Sea and make your plans to spend a week with the Real Estate Guys, Peter Schiff, Robert Kiyosaki, and an all-star faculty on the 18th Annual Investors Summit at Sea.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hi, this is Doug Casey, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. We're so glad you tuned in today. It's a great show. Ask the Guys. We'll do another one in a few months because the questions keep coming in. If you have a question for the Real Estate Guys, go to the website at realestateguysradio.com. Click the button that says Ask the Guys. This question comes from Daniel in Örebro, Sweden. I hope I pronounced that correctly. Daniel in Sweden is saying, what's the difference between the new Investors Summit at Sea and the Future of Money and Wealth Cruise in 2018? Thanks, Daniel. Well, there's actually not that much difference. Every year we do our Summit at Sea. This will be our 18th year in 2020. And in our 16th year, we added a couple of days beforehand, and we had the most amazing faculty for a 2-day program, independent of the summit, called the Future of Money and Wealth. If you were coming on the summit, those were your first 2 days. And from then, you went with the entire faculty onto the cruise ship for another week. In this case, we've got many of the same faculty members coming, and we will be talking a great deal about the future of money and wealth this year. Of course, we videotaped the whole thing, and it's available as an extraordinary program. And boy, do we stand behind everything that was said there. Anyone who listened to the advice given at the Future of Money and Wealth and acted on it is a happy camper today. Find out all the details about the 18th Annual Investors Summit at Sea on the website at realestateguysradio.com under the button that says Summit at Sea.
Hey, if you're interested in that Future of Money and Wealth video series, just send an email to future@realestateguysradio.com and we'll get you the information. But it is all of the presentations from the 2-day on land Future of Money and Wealth, plus a few bonus presentations that came directly off the Investor Summit at Sea. Great feedback on that. And again, Robert, to your point, the whole reason we were doing that is there were many warning lights going off telling us that there was going to be some substantial changes. We were just coming off the big boom in Bitcoin. We were concerned that that thing wouldn't last. Clearly it didn't. And there were some reasons why, and you could see it coming. But the bigger picture is, what did the boom in Bitcoin say? What did what's going on in China say about the future of money and wealth? And now gold, what we talked about at gold, 3 years ago, 4 years ago, compared to where gold is at today, people who acted on what they learned there made a lot of money. And that's why you go to these things. So, the question is, well, gosh, it was so expensive, I'd have to fly, blah, blah, blah. Well, all the people who had a chance to go, who thought about going and didn't go, lost a lot of money. They didn't save money by not going. They lost money by not going. But the good news is many of the things that were happening then are still happening now. And I can't say what the future is going to bring, but all the indicators are that the trend that we identified at Future of Money and Wealth is continuing. It's not like this epic, cataclysmic, happen all at once type of thing. It's more like a slow motion train wreck. And if you understand what's going on and the way the mechanisms are speaking to you, the clues are in the news. We write about it all the time. We talk about it on the show all the time. You can begin to make moves to be on the winning side of what's most likely to occur. We say all the time, better to be prepared and not have a crisis than to have a crisis and not be prepared.
June 11th to the 20th is the 18th Annual Investors Summit at Sea. A lot of folks are already going, like Ed Griffin, who wrote The Creature from Jekyll Island, like Peter Schiff, who wrote Crash Proof, like Kenny McElroy, who is Mr. Real Estate, and of course the Rich Dad Advisor for Real Estate. And coming back with us live in 2020, Robert Kiyosaki, plus tons more. You definitely want to be at the Investor Summit. All the details on our website. Thanks for that, Daniel. Our next question, speaking of gold, comes from Brendan in Johns Creek, Georgia. Hey, guys, first off, awesome podcast. So informational, even beyond real estate. And by the way, that's strategic. We believe that before you're a real estate investor, you're an investor. And even as guys whose core is real estate, you really have to pay attention to all the other investments. So my question is in regards to gold. I just listened to an episode where you guys make gold sound like it is completely liquid, like it can be swapped for currency anywhere in the world, even if the power goes out. Now, I'm only just getting started learning about precious metal investing, but from what I've seen, the process of investing in gold and silver involves either using the internet or making a call, and these metals don't get sent to your house, but are stored somewhere. So, how can this be liquid and easily accessed and converted in a crisis situation? Hope you guys can see this and can point me in the right direction. I'm going to continue to dive into the topic because I believe precious metals is a great asset class to be invested in at this time. Thanks again, guys, Brendan. All right, Brendan, well, we're glad you brought this up, and I know our financial strategist is glad you brought this up. There's all kinds of different ways to invest in the metals.
Yeah, so it's no surprise that when you went looking on the internet for ideas about investing in gold, you ran into a lot of what I'll call propaganda that is trying to persuade you to do gold in such a way that you don't actually own and control it. There's some misunderstandings in your understanding of how it works. And so just to keep it simple, if you were to just take a pile of cash, less than $10,000 in the United States, and you were to walk into a gold dealer in your local town, and you were to ask to buy a number of gold coins so that the total purchase came in at under $10,000, and you put a stack of cash on the counter and walked out with coins, the person selling you wouldn't even know your name, just like if you went and bought a taco at a taco stand and paid cash for it, right? There's no evidence of the transaction. You're not trying to hide anything, but you do have a right to your privacy. And a lot of people who buy gold in that way are doing it specifically because they want privacy.
And Russ, just a quick thing that may be obvious. The exact opposite of that transaction can happen too. You walk in with the gold and take cash. So in that way, super, super liquid.
Exactly. I mean, that was exactly going to be the next words out of my mouth. It's very portable wealth. And here's the thing you need to understand. This is what I think a lot of the younger folks, and I have this conversation with one of my sons all the time because he really is about cryptocurrency. But the thing about gold is, if you really understand what value is a repository of energy. As a human being, you go out and you do labor, you earn money. And that money stores the value of the energy you put out to do the work until you're going to transfer that value to somebody else in exchange for the fruit of their energy, which is whatever product or service you buy. So all products, all services represent energy. Energy is at the foundation of everything. When you own a piece of gold, it isn't an IOU on an energy expenditure. All of the energy is already expended. If you buy Bitcoin, you can't redeem that without a future expenditure of energy. And I'm not putting down Bitcoin. I just want you to understand the difference. So Bitcoin has some advantages. You can send it across borders and you walk across the border with nothing but your code in your mind. And it's highly portable. And that's why people like it, especially if they're in repressive regimes. But gold is pretty portable too. And throughout history, people have used gold even when gold coins and things were objects of government confiscation. They really didn't confiscate. I think we're going to talk about that in a minute, but that's the reason why people wore so much jewelry. It was a way to have wealth that was portable. Anyway, so gold is highly liquid because there's always a bid on gold. And right now, there's a lot more bids than there are sell, which is why we've seen the price going up pretty consistently for the last few years. And you have to ask yourself, well, why is that? And who are the buyers? And I could do a whole conversation on that. But if you look into it, you're going to find out that the world's central banks, which are the ultimate insiders of paper currencies, are buying gold. That tells you something. Don't have time to expound on what it tells you, but ask yourself the question, what does that tell you about paper currencies?
So, Brendan, it does take some time to get educated on this, so hats off for doing that. Do understand that the biggest advantage to precious metals is the fact that you don't have any counterparty risk when they're in your physical possession. Almost every other investment has some other party that can put a wrench in the works. Imagine you own a property free and clear. Well, there's no lender. If there was a lender, that would be a counterparty. Well, what about property tax? You don't pay your property tax, and eventually they're coming to get your land. So that's counterparty risk. And it's true anytime your asset is somebody else's offsetting liability. And if you think through pretty much all investments, stocks, bonds, mutual funds, ETFs, on and on and on, they all have counterparty risk. Gold and silver in your possession do not. Now, we said earlier, there's lots of ways to invest, and walking in anonymously into the neighborhood gold store is not the only way to invest. In fact, there's great, reputable dealers out there. As you probably know, every year we go to the New Orleans Investment Conference. It's the longest running investment conference in the U.S., and you'll meet all kinds of great folks there in the gold space, not just people that sell coins and bullion, but miners, folks that actually go out and find gold, extractors, people that are doing that, producers, people that already have found gold and are pulling it out of the ground, and you can learn a ton. So a huge way to get educated quickly in gold, silver, and even other resources has come out to the New Orleans Investment Conference. It doesn't happen to the last quarter of the year, but still you want to plan on coming to that. In the meantime, continue to get educated about it.
Yeah, so a couple things you can do. If you're interested in the New Orleans Investment Conference and you want to get more information, including how to come to our very now famous suite party where we introduce you to all of our friends, it's a ton of fun, just send an email to neworleans@realestateguysradio.com. One of the guys who is always there is a good friend of ours now, Dana Samuelson. He's just a great gold guy based in Austin, Texas. You can find him in the Resource Center, but we've had him on the show in the past, and he, as we often ask our subject matter experts to do, wrote a special report specifically about precious metals. And as you might imagine, the way to get that is to send an email to preciousmetals@realestateguysradio.com. And that's a great place to start your education too. But the bottom line is you can order coins online, have them delivered to your home or bars or whatever you choose to. You can go to a retailer in your local neighborhood, as I explained, and you can pay cash, you can write a check, you can use your credit card. There's more economical ways to do it. So sometimes they'll charge a premium for a credit card. You can buy and sell there. You can go to coin shows. If you come to the New Orleans Investment Conference, typically you can buy metal right there in the exhibit hall. So it is definitely possible to own physical metal in your physical possession. To Robert's point, you have complete control. It's portable. There's no counterparty risk, and there's always a bid on gold. So it's a way that many people throughout the world park wealth, and they can convert it into any currency that they want wherever they are. And usually it retains its value very well against virtually every currency over time. If you look at the 100-year history of gold versus the US dollar, gold wins. In fact, gold has been, in dollar terms, one of the best performing investments of the last year and a half. So there's a lot of reasons to own gold. And even if you're not interested in gold as an investor, and I really don't consider it an investment, I consider it an alternative form of savings. But gold, if you watch the gold market, it tells you a lot about what's going on with currency and bonds and the financial system. And every investor, especially real estate investors, should care about that, because if you denominate your wealth in dollars, if you collect rent in dollars, if you use debt denominated in dollars and you pay interest and you care about interest rates, studying gold helps you understand the direction of all those things.
Now, our last question is related, and we'll try to make it quick. James from San Anselmo, California, writes to us about his concerns about gold, and he's got some good ones. And he says at the end, by the way, I own gold, so these concerns are real. Please help me, real estate guys. Here's his concerns. What if they call it in, as FDR did, probably at a discount to the market rate? And that's when folks had to turn in their gold. Okay, that's a good point. 2, if I put it in the bank's safe deposit box and they close the bank in a meltdown, will I lose it? If I put it in my house and someone finds it and steals it, will I lose it? If I buy insurance, then the government will again know that I have it and they could confiscate it. If I hide it or bury it in the backyard and I don't tell anyone and lose my marbles when I'm old, then I'll lose it. Where or how can we safely keep gold in the event we need it for trading or a major meltdown? And how does Kiyosaki store all his? Well, we'll start with the end. We know the answer, but we can't tell you that. You want to ask him, come on the Investor Summit, you can ask him. I'm not saying he'll answer, but the reality is these are all potential concerns. One of the things Jim Rickards says in Currency Wars is if gold goes to, say, $10,000 an ounce, who's to say the government won't impose a 90% tax when you sell it? So there is no end-all, be-all investment. I will tell you this, when it comes to confiscation, there's just nothing any of us can do about that. Now, I know that there are people who didn't turn it in back in the day, and their great-grandkids are probably glad they didn't. I'm not saying you'd break the law, I'm just saying. So, would you put all of it in a third party? As soon as I put my gold coin in a bank safe deposit box, guess what I just added to my gold investment? Counterparty risk. That's a counterparty.
Right.
So I'm not saying you might not put some of your metal there, but certainly not all of it. Same thing when it comes to hiding it in your house. And there's all kinds of ways to learn about that, far beyond the scope of our expertise or this show. Buying insurance against it, well, maybe. Hiding it in the backyard, I don't know that I suggest that. Can you safely keep it? There are private companies that specialize in this. So the answer is yes. You've just got to do your research and understand there's different reasons for holding it. If you want to have some you can get to quickly and transport a great deal of value at once, that's different than just holding it to hedge against inflation.
Yeah, I mean, ultimately, there is nothing you can do to eliminate all risk. The last point, if you lose your marbles, it doesn't matter where your gold is.
Good point.
Right?
Who cares?
That part doesn't matter. But if you have people you trust, that's what trustees are. In the old days, that's the way it worked. You gave somebody that you trusted something of value to hold it for you. And again, to Robert's point, you have counterparty risk when you do that. Will they perform? Whether you trust the bank, whether you trust an offshore repository, an onshore repository that's insured and guarded. You may want to have some hidden someplace, not in your residence. You may want to have some in your residence and buy a good quality safe. So you can diversify some of the risk of owning your gold by holding it in different places in different forms. And then, the thing about confiscation, I read a lot about that. I'm not saying the government wouldn't do that again. Maybe they would. But even when they did, they technically didn't confiscate it. What they did was they bought it. And they bought it for $20.67 an ounce back when that's what it was worth. Shortly after they bought it, they revalued it at $35, which means they ripped people off because they diluted the value of the $20 that they gave them.
What? Are you saying the government ripped people off at some point?
I don't know why there wasn't a revolution right there and then, because basically the government came in and made you trade in all your real money for their fake money. It'd be no different today than if someone came and held a gun to your head and said, hey, give me all your dollar bills, your $20 bills, your Benjamin Franklins, and I'll give you a bunch of monopoly money. But it'll purchase the same. And then as soon as you do it, they dilute the purchasing power. Say, okay, it won't purchase as much. Every $20, it's going to take $35 now to buy the same thing you could have bought with $20. But that's what FDR did to the American public. So they thought that was necessary to save the financial system. Some historians maybe say that was true. I don't know. But thankfully in 1974, thanks to the founder of the New Orleans Investment Conference, the government lifted that when Gerald Ford signed an executive order rescinding that executive order that FDR had signed, making private ownership of gold illegal. And I think smart investors, hedged investors, have been making gold a part of their portfolio for a very long time. And if you look back historically, the people who have done that have done well, not in making money, but in preserving their wealth. I'll just say one thing from a financial strategy perspective. You don't buy gold to make more dollars. But if you want to get wealthy with gold, in my personal opinion, and it's only my personal opinion, is you buy gold and you acquire debt. Because when you acquire debt, and real estate's the best way to do it, you lock in the purchasing power of the dollar with the debt. And you have the property now, and you're collecting rents, and you're using the rents to service the debt, and then you hold the gold away from the property. Later, if gold goes up in value in terms of dollars, it probably means everything else in society is getting more expensive too, but your debt isn't. which means if you bought $100,000 of gold and you took out $100,000 of debt, and then gold went up to $150,000 or $200,000, you could sell half your gold and pay off all your debt, and now you have half the gold plus all the real estate. So gold and debt go together if you want to use it to build wealth. Otherwise, you're just purchasing gold as a form of savings to hedge against currency devaluation and preserve purchasing power. And I could do a whole lot more on that. That's some of what we talked about at the Future of Money and Wealth, and some of the things we talk about on the Investor Summit at Sea. And I'll just say one last thing in regard to the Summit at Sea. We go there and we bring in these big name people, and they talk about high concepts. We talk about economics and the financial system, and we talk about what these different asset classes like oil and energy and gold and currencies are saying about what's going on in interest rates and things that affect real estate investors. And then we have a whole bunch of really smart real estate investors that listen to all this and get together and say, okay, now, based on what these guys think is going to happen, what should we be doing at the street level to either capture an opportunity or mitigate a risk? And you can't get that kind of intelligence anywhere. I mean, and you certainly can't get as much work in a week on your own than you'll get done as a week on that summit. That summit should make people money, and that's why we have hundreds of people that come back year after year after year, including our faculty, none of whom we pay, because we all learn to be better, smarter investors in an environment that just cannot be found anywhere else.
We got some smart gold guys coming this year. Peter Schiff's coming back. Robert Kiyosaki's coming back. And the editor of the Gold newsletter, Brian London, back with us, plus Dana Samuelson and a whole bunch of summiteers that have invested in gold and silver. So that would be a great resource. And we can talk about those things when we're out on the high seas outside of any country's jurisdiction. Come with us. Get all the details on the website at realestateguysradio.com under Summit. Thanks so much for your questions today. We'll do another episode in the coming months, so get your questions in by going to the website at realestateguysradio.com and click Ask the Guys. Next week on the program, superstar real estate investor and syndicator Kenny McElroy will be back with us. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.